This week, we're going to talk about the hidden challenges of diversification, namely how it sounds so right, but can feel so wrong. I think if you go up to a lot of investors, at least somebody with some semblance of experience, and say, is it good to be diversified as an investor? They'll say yes. We'll sit down with many people and say, we want to make sure you're well diversified, and that's all sounds very, very great. And then you start down the journey, maybe for people who don't quite know what that means. We're going to delve into a little bit today. And at times it can feel so wrong. There's a few reasons for that. The first of which is, by definition, if you really think about it, if you're diversified, something won't be working at all or working well at any given point in time. Why is that? Well, by nature, if you're really diversified, you want to have different investments, different asset classes that aren't going to act the same way in any certain economic cycle. That's why you're diversified, i.e. if everyone's really afraid and something like stocks are going down, historically other asset classes like fixed income or gold might be doing better. And so you want to have a piece of all of this. The reality though is, for most people, understandably, want to be in something that's working all the time. And so you'll hear things like, well, why do we hold this thing? Or why do we hold that thing? Because they're looking at the prism of, and subconsciously, I just want to be in the best thing at every point in time. That, of course, would take a perfect ability to time markets, to be able to foresee the future. Again, things that when you ask people, they'll say, yeah, I know that's not really possible, but that's what they're there for. At the end of the day, an advisor, at least an advisor that's being honest with you, should not be telling you, to use an analogy, that they can change the weather or cease the weather. To my knowledge, only one person's ever walked the earth that could do that, and it's certainly no one here at 10 Capital. What we claim to do is we understand there's going to be sunny days in the markets or in various asset classes. There's going to be stormy periods. We will be able to build a plan, a portfolio that can help you safely navigate through the inevitable challenges that are going to be a part of being an investor. Point two is, it rarely feels good. On top of the fact that you probably have something that's either down or lagging vis-a-vis some other asset class, it never feels super exciting, especially relative to, say, the stock market. If you're in a really well-diversified portfolio, but everything's down, you're probably down as well, just not down as much. That's not the most exciting story to share with most people, though it's a powerful one. And then when markets are doing really well, again, thinking mostly of the stock markets, you're gonna lag because, again, you're not just in those high-flying stocks. It isn't until you step back and really look at what that does over time, we'll get to that in a minute, that you realize, again, the power of diversification, that while at any given point in time it might not feel like it's working, over time it is. The third challenge of being a diversified investor is it probably means you're going to be in asset classes that you're not as familiar with. And while it's a logical fallacy to think that if you know or invest or use in a certain stock company, that somehow it's going to do better or that you'll do better, it is how we feel. And being in things that seem a little bit less clear, or a little less common, again, takes away that feeling of familiarity. There very well may be things, and often are, in our opinion, things that will help investors over time, but again, are things that are not necessarily common, familiar, can give people those warm and fuzzy familiarity feelings that they desire. So if these are all the challenges, why do it? Well, first and foremost is performance takes many forms. And so we've talked about our LIVE methodology, liquidity, income, volatility, return. All of those really need to be taken into account. And for most investors, I think it's safe to say that their idea of success and performance is making money over time. How you do it is a very important ability of not only achieving the numbers you hope to achieve, but also having success in the way that actually is going to work for, again, that theoretical money management interplay with the practical realities of life. Unexpected costs, current income needs, etc. Take a private equity. We all know stories of our buddies who invested in some company and made oodles and oodles of money. Once it's been successful, we rarely take into account the risk that that person or that investment actually might have had, even if it did work out. Or more importantly, the liquidity, that that money was locked up into an investment that they couldn't get out of until there was some type of event down the road. For most people, doing that with certainly the entirety or even some of their money is not quite possible. What do they need? Well, one of the things they need is income, cash flow to pay for their needs, particularly if you're nearing or in retirement. Diversification, a lot of those asset classes, can help enhance income streams within portfolios as opposed to just, say, the general stock market within an index fund. Third is improved volatility and drawdowns. We're going to link to a great chart set I'll cite here from AMG. First is you'll see about a third less drawdowns within a diversified portfolio as they defined it, basket of different asset classes versus just the stock market. Why that's so important? A lot of the reasons we make these videos is the mindsets and the emotions of being an investor. Giving things the time to be successful is so important. And volatility, drawdowns are certainly the biggest trigger that can short circuit people from sticking to their plan. If you can dampen that, if you can lessen those drawdowns, you lessen the most emotional reactions, you increase people's probability of staying the course. Pages 15, 16 to go into that, just even a third less volatility. And page 16 looks at 2008 and shows that, hey, if you were in this diversified basket of investments, you had a far shorter period for the one that they're looking at, a 13-month recovery as opposed to 37 for the stock market as a whole. Does this mean that all is lost, that there's no returns to be made? Again, these numbers are approximates and theoreticals, but as you'll see on page 15 and 16, you actually get the vast majority of the upside of the market, or at least a very healthy return with all this improved volatility and improved income. And so that, again, is really the real reason people look at diversification, that ability to make financial progress and still be able to lessen, dampen those things, running out of money, income stream, too much volatility that can threaten the emotional aspects of being an investor. As you say, a good advisor's job is not to convince you, although so many still do, that they've got some black box technique to predict the weather, to change the weather, but rather to play that role of ship captain to help you navigate the storms that are inevitably part of any investor's life. If you're looking for someone to help come alongside, we're always here for you. If you've got questions about any of this, we welcome anytime.